Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to go back to the basics and talk about the number one income generating strategy utilizing options. And I really want to talk about how to master this one strategy, because it's really the foundation of learning how to trade options, understanding options pricing and how they are affected by both time and the stock moving higher and lower. So if you can master this one strategy, it'll give you a huge leg up in being able to trade other types of strategies, such as buying call options and other types of more advanced strategies. So let's go ahead and get started and hopefully give you a clear sense for how to utilize the strategy and all the tips that I have for trading it. Now, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are going to discuss during today's session. So the number one options trading strategy, options income generating strategy, is a cover call. We're going to briefly go over what a cover call is for those of you that may not be familiar with it. But most importantly, I think the best way to learn is go through a real example. And what you're going to find through this session is that hopefully there are plenty of opportunities for you to add income to your portfolio that you may be missing out on today, because perhaps you're thinking about cover calls in a more boring fashion, or perhaps you're thinking to yourself that cover calls are only for people who have large portfolios who can buy 100 shares of the stock. We're going to discuss all of those things and how you can find opportunities even if you have a small portfolio through our opportunity report. And then I'm going to share with you some of my general trading tips, things that you should be looking out for when you're selling cover calls, and more importantly, how to manage them once you are in a cover call. And then we will open this up for Q&A here at the very end. But the primary thing that I want to help everyone walk away from today's session is a clear understanding as to how you can generate consistent additional yield to your portfolio using options. And I think the important part here is additional yield, because you're probably earning some yield on your portfolio. Some stocks in your portfolio probably pay a dividend, but how can you increase that 2, 3, 4, 5 times what you're currently getting from your dividend yield by adding this one strategy, cover calls, to your portfolio? That's what I want to show you here today. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you the technology and the opportunity reports that we have built to hopefully help you implement what you've learned here today. So let's first start off by talking about what is a cover call. A cover call is very simple. What you're doing is you're simply selling a call option. Now, if you were just to sell a naked call option, you would be taking on premium in exchange for truly unlimited risk. And this is, generally speaking, not a strategy that you necessarily want to take. It's basically the exact opposite of buying a call option. How many of you here have bought a call option in your portfolio? Please bring up the chat window in the bottom of your screen, and please type yes into the chat window if you've bought a call option before. Okay, I see a lot of yeses. Okay, so think about it. The person who's on the other side of that transaction, when you buy a call option, you have limited risk in exchange for unlimited reward. While the person who has sold you that call option is the person who has limited reward because they're collecting the premium that you've paid, and they have unlimited risk. If the stock keeps going higher and higher and higher, they'll keep losing more and more money. Basically, the money that you gain, they lose on the other side. So why would anyone do this? It's all for that premium. Now, what you're trying to do here with a cover call is you're trying to sell that call option to the call buyer, but because you're doing it with stock that you already own, you don't have unlimited risk to the upside. That's really the key here, is you're selling cover calls because you have the obligation to sell the stock at a specific price, no matter where the stock is, but that obligation is covered by stock that you already own in your portfolio. Because when you sell a call option, you have the obligation to sell the stock at a certain price sometime in the future, and you're going to get paid to do so. Now, what is that obligation to sell your stock at a higher price sometime in the future? What does that sound like? And for anyone who has ever bought a stock or ETF, you're going to realize that that sounds exactly like placing a limit order. Because when you place a limit order, so if you have a stock and you place a limit order at $95 to sell the stock, what does that obligate you to? It obligates you to sell the stock at 95 when the stock rallies to that price. Well, a cover call is very similar in nature. It obligates you to sell that stock in exchange for the stock that you currently own in your portfolio. And there's only one limitation to the strategy. It's because for every call option you sell, you must own at least 100 shares of the underlying stock. You must own at least 100 shares of the underlying stock. So for a lot of the traders, for those of you that are watching, maybe you have positions where you only own 50 shares of the stock or 20 shares of the stock, and you don't have 100 shares of it. Well, we're going to address that in terms of how you can potentially find opportunities with this strategy, even if you don't necessarily have 100 shares of a lot of different stocks. So the goal here is to really help you collect yield on the stocks that you do have at least 100 shares of, to help supplement the income stream of your portfolio. That's the whole goal of selling a covered call. And this is by far the #1 options income strategy, or actually just #1 outright option strategy altogether. 40% of all trading transactional volume is in this one strategy alone. And there's a reason for why large institutions sell cover calls on the equity positions that they own. Does that make sense? Please type 1 into the chat window if that makes sense to you. Perfect. Okay. So I think the best way to learn is to go through example, right? Let's say you own 100 shares of Seagate Technologies and it's currently trading at $90. And you think that your goal is to sell 100 shares of it at $100, which is your price target. So you own some stock at $90. You think the stock's going to hit 100. So what you want to do is you want to basically take profits when the stock rallies to the $100 target price that you have on the stock. So this is really where we split the experience into two. You have your stock investor, and then you have your options investor. As a stock investor, and many of you here on this call currently invest or trade in stocks. It's very simple. You place a limit order at the price, the target price that you have, and you simply wait. You wait for the stock to rally. And when you place a limit order, this doesn't provide any type of income when you place a limit order. You have an obligation, but you have no income from it. The options investor on the other side would look at selling, let's say, a $100 call option. So we're in October right now. Maybe let's look at selling a November $100 call option. And the $100 reflects my target price. But the difference here between a limit order and a cover call is that when I sell that call option, a call buyer, the buyer who's buying this $100 call option from me, is paying me $1 to do so. So what I'm doing is I'm obligating myself to the exact same obligation as the equity investor, but I'm getting paid $1 to do so. And what this does is it generates an income stream, because between now and November expiration, I keep $1. No matter what happens, if the stock rallies, if the stock declines, if it moves sideways, if I hold this call option to expiration, I keep the $1 that I sold the call option for. And this is what can generate a potential income stream. And let's take a look at the difference between the two. So if I own the stock at $90 a share and I place a limit order, my max risk remains at $90 a share. But when I sell a cover call, it immediately gets reduced to $89 a share. Doesn't sound like a whole lot, but I'll show you how this adds up in the long run. So right off the bat, once I sell a cover call, I have lower amounts of risk in my total trade, because now my cost basis is reduced from $90 to $89. My potential reward gets increased because by a limit order, my potential reward is exactly the same. If I bought at 90 and I sell at 100, my potential reward is $10 a share. But if I sold the cover call, my risk reward gets skewed. Not only is my risk reduced, my potential reward is increased. So instead of risking $90 to make 10, I'm risking 89 to make 11. Again, doesn't seem like a whole lot, but we'll show you how this starts to make a difference in the long run. And then when you when you place a limit order, you have exposure in the stock. So if the stock goes higher or lower, you're exposed to that. And the only thing you have to show for that exposure really is that you can potentially collect dividends until the stock reaches your $100 price. And then at which point you will no longer have an exposure in Seagate Technologies. Now, if let's say you were to sell a cover call, in this particular case, I'm generating $1 in roughly the 1 month time that it takes for the stock to rally. But the stock may take more than a month for it to rally to $100. It may take 3 months, maybe take 6 months or a year. And as long as I use a cover call strategy each month longer than it takes to reach my $100 price target, I can keep generating income in that portfolio. So not only do I collect dividends, I'm also going to add on top of that the cover call yield that I collect. Now, keep in mind, $1 on a $100 stock is 1%, but that's 1% over about a month and a half of time. So if I can do that consistently throughout the year, that's going to generate a fair amount of yield. And many times you're going to see that amount of yield is significantly higher than the yield that you get from the dividend stream itself. Does that make sense? Please type 2 into the chat window if that makes sense to you. And the goal here is to simply replicate what you are doing right now with a limit order, but adding an income stream on top of that. And this is really where the rubber meets the road in terms of practical application of this type of strategy, because the efficacy of this strategy is completely dependent on what expiration date and strike price you choose on this specific strategy. So I'm going to do a little bit of an experiment here. Okay. Let's just focus on one thing at a time. I'm just going to tell you outright, we've back tested cover calls about just about every single possible expiration date, everything from a few days out to all the way to about 6 months out. We tested various expiration dates, and the optimal expiration date is usually about 45 days out. Okay. So I'm just going to tell you that. Now, what I want everyone to think about is, what strike price would you choose? Seagate Technology is currently at $88.60. You can choose, let's say, a 95, a 97, or let's say 100. I'll give you 3 choices, 3 different strike prices: 95, 97 and a half, or 100. Now, if you sold the $100 call option, this will collect about 75 cents. That is 0.84% of the stock's value over the roughly 45 days. And that's going to annualize out to about 7%. If you told the 97 and a half, you're going to collect just a little bit over $1. That's a 1.18% of the stock's value. That annualizes out to 10%. If you chose the 95, you're going to collect $1.50. That's a raw return of 1.5% and annualizes out to 14.56%. So I'd like to ask the audience here, if you had the choice between the 3, 95, 97, 100, choosing $1.50, $1, or 75 cents in income, which one would you choose? Type your answer in terms of your strike price on the chat window. 97, 95, 100, 100, 95. Okay, so it seems like there's a lot more 95s and 97s. Next time I'll do a poll so that I'll see kind of what people actually provides. But and there's a couple of questions saying it depends on if I want to keep the stock. It depends on other factors. If I want to sell. And this is really where the science from our back testing is very clear. There's no dependencies. No matter where you think the stock's going to go or dependencies, what you want to use is a probability-based approach to collecting income. And our research shows that you want to use delta, a probability-based approach to selecting your strike prices. And what does 15 delta mean? A 15 delta call option means that there's a 15% chance, based on the implied volatility of the option, that this stock will be above $100 at expiration. That means you have about an 85% chance that you're going to keep your 75 cents. 85% chance you're going to keep your 75 cents and a 15% chance that you're going to take profits on your stock and you're going to sell your stock at $100. Now, why does this strategy, this 15 deltas, why does this perform better in the long run versus this strategy, which collects a lot more income, right? Why wouldn't you want to collect a lot more income? A lot of people selected the 95s because you want to collect as much income as possible. 14.5% of income certainly sounds better than collecting 7% of income. However, what you have to realize is that when the stock rallies, here you're collecting $1.50. But what you're doing here is you're actually only collecting an extra 75 cents. And what happens, what are you giving up for 75 cents? What you're giving up is a whole $5 of upside. So if the stock rallies substantially, what would you rather have? $5 in capital appreciation of the underlying stock, or would you want an extra 75 cents in income? I think the answer is pretty clear for everyone, right? Everyone would prefer to have that $5 in upside versus an extra 75 cents in income. And that is the scenario that plays out over and over again. When you sell hundreds, if not thousands of covered calls throughout your lifetime, guess what? The extra 75 cents is not worth it because you're going to consistently give up $2, $3, $4, $5 in an upside in exchange for that extra 75 cents. And that is a formula that does not work out for you in the long run. So whenever you're choosing strike prices to sell for cover calls, you always want to select roughly very low delta, 15, 20, even 10 deltas. Those are the sweet spots if you want. And what you're going to find is that the yields are not going to be super attractive, but they are going to give you that upside. And remember, the biggest amount of risk that you take with a cover call is the fact that you have risk in the underlying stock. You're exposing yourself to the stock. In order to offset the risk of taking that risk of owning the stock, you better get paid when the stock rallies. But if you sell a cover call that's too aggressive and you're just trying to collect an extra 75 cents, what you end up giving up is a lot more upside. This is kind of exchanging short-term greed in exchange for long-term capital appreciation. So that is, again, the upside that does not make sense for you in the long run. And for those of you that's saying it should be $75 instead of 75 cents, that's that's yes, you're right, but then you have to then multiply the stock by 100 shares. So difference between $88 and $100 is not $12, it's $1,200. So what you're doing is you're giving up $75 in exchange for $500. So the two are is the same at the end of the day. So it's really important that when you think about cover calls, you don't prioritize income. Even though we talk about it as an income generating strategy, income is not your sole focus. Your sole focus is that you are able to capitalize on the appreciation of the stock that you own when the stock rallies. And the goal here is to basically pick a strike price that's so far out of the money that it really takes an outsized event, maybe some kind of unknown news event, something that kind of really catches you by surprise and allows you to take profits from that. And then when the stock is just doing its normal thing, it's moving its normal up and downs, you're trying to collect roughly, in this particular case, about 7% in the underlying stock's value. And keep in mind, this is a stock that generates 3% dividend yield. So even in just when the stock is doing its normal fluctuations month to month, you're still doubling the dividend yield. You're tripling your income because you're going from 3% to almost 10% when you add the dividend yield plus the cover calls. And when the stock rallies significantly, you're going to participate in that. You're not going to lose out on that big move to the upside when you choose these lower delta strike prices. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. If you take nothing else from today's session, this is the most important thing that you want to take away from today's session is choosing these low delta call options that have relatively low yield compared to those more aggressive calls, but you're going to be able to capture upside in the underlying stock. And that's what's going to pay dividends in the long run. So let's talk a little bit about the tools that we have built here at OptionsPlay to help you find these opportunities. You're going to find them in your hub, which is something that you can access from your OptionsPlay tool, where you have the link here at the top called Education and Resources. When you click on that link, it's going to take you to the OptionsPlay hub. Within the OptionsPlay hub, you're going to find the cover call report. That's going to help you find opportunities for this specific strategy. And not only is it going to help you find opportunities, it's actually going to find the specific expiration date and the strike price for you so that you don't have to go pulling up an options chain and figuring out what's the 45-day 15 delta strike price for Apple or whatever stock that you're trading. This report does it all for you. And what we do is we sort the report based on raw return, meaning how much premium are you actually collecting as a percentage of the stock price from this cover call. And it's sorted for you based from highest to lowest. So I usually tell investors simply to go down the list, but we've simply recently entered a search function. So what you can do is you can just search for the stocks in your portfolio. So if you own Facebook, you can simply type in Facebook, and it will tell you to sell the November 375 strike. And remember, the stock price is currently at $332. So this is a strike price that's about 45, almost $43 out of the money. So the stock has to rally $43 in the next 43 days before the stock is called away. Otherwise, you're going to collect 0.77% of the stock's value, which is an annualized return of 6.5%. And this is something that you'll be able to do as long as Facebook is just fluctuating its normal fluctuations. It has to make an outsized move to the upside in order for your stock to get called away. And if that happens, guess what? You've made a lot of money on Facebook stock. The stock has rallied $40, multiplied that by $100. That's a $4,000 gain on the underlying stock that you've made. And in addition to that, you've collected here about $250 in potential income. So if this is for example, if you own Facebook stock, you can click on the Facebook symbol here on the left-hand side. And when you click on it, it'll bring the trade up here in OptionsPlay. So we've really tried to make these reports as easy as possible so that you can quickly find the opportunities and then evaluate the trades in Facebook. Remember, Facebook is a stock that pays 0 dividends. And if you own the stock currently, it's obviously a little bit of a painful trade at the moment, but this is where you can add an additional 6.5% yield to your portfolio by holding Facebook and selling cover calls against it. This is really how you can go about deciding whether this is the right trade suited for you. I generally tend to find that I want to at least double the dividend yield on a cover call, right? So here I'm getting nothing from the dividend. So getting a 6.5% return is fantastic in terms of being able to look at this. And the stock has to rally in this particular case to $375. And the stock, even if the stock does rally $375, I would make $4,823.50 from where Facebook is today in order for that to happen. So this is really how you can go about analyzing the trade. And if you want to place the trade, click on the trade button and you'll have everything you need to enter this trade into your platform. If you already own the stock, then you only have to sell the November 19th 375 call, collecting $2.55 or $255 for the contract. Now, this is really where you have to look for the stocks that you own. Now, in our old spreadsheet, you had to search for it now, or you had to go down the list finding the stocks that you own. Now you can just type it into the search function on the upper right-hand corner. This is a report that generates every single hour throughout the trading day. So you're always going to get the latest opportunities based on where the market's currently trading. So we can take a look at a few other opportunities. Let's just take a look at some of these. I'm going to try to find some stocks that many of you own in your portfolio. Let's take a look at let's look at Peloton, because recently we've made a trade here on Peloton. Peloton's currently trading at about a little over $87. This is telling me to sell the 110 strike price, which is a strike price that's 25% above the current price. The stock has to rally 25% in the next 43 days before this stock is called away. Otherwise, I collect 1.6% of the stock's value in the next 43 days, which is an annualized return of about 14%. Okay, so let's take a look at this Peloton trade here. I'll close this one out. We'll open up Peloton. So let's say you're bullish here on Peloton, like I laid out here, right? Which, what I was saying is that we've hit this double bottom here. This was an opportunity to play for a bounce. We got a bounce here today. So maybe you think that Peloton's going to rally, and 110 is pretty high up here. 110 is all the way up here, right? The stock has to rally all the way up to about 110 in order for the stock to be profitable. And I would say that if the stock rallied up to 110, that would be a pretty successful trade. And I'd be pretty happy with selling my stock at 110. But as you can see here, what I'm collecting is $1.40. Now, $1.40 doesn't sound like a whole lot, but on an $87 stock, that's 1.6% of the stock's value. So I'm collecting 1.6% in just 43 days. And this is a stock that pays, again, 0 dividends. And what I'm trying to do is I'm trying to collect, in this particular case, 14% yield while I hope that the stock is going to make a big move here to the upside. And what that means is that if I do this over and over again throughout the year, even if the stock was to decline 14% over the next year as I hold the stock, I'm not going to see any losses, because whatever I gain in my cover calls, or whatever I lose in the underlying stock, I'm going to gain back from my cover calls. So I have about a roughly 13.5% downside protection if I'm able to sell cover calls consistently throughout the year. And if the stock does rally 25% at some point throughout the year, I'm going to capture those profits and simply hopefully take those profits and roll them into the next trade. And we'll talk about kind of how we roll that into the next trade in our next session. But today I want to focus on how do you take profits on the stocks that you own in your portfolio. And when the stocks are just moving sideways and moving a little bit sideways, you're able to collect a fair amount of premium for your stock. And when the stock rallies significantly, you're able to take profits on that. Does that make sense? Please type 5 into the chat window if that makes sense to you. I'll just look at one more example just to kind of drive this stock home. And let's look at some stocks that are probably widely held. What's a widely held stock? That's low. Oh, you know what? One thing that I do want to point out here. Let's just go over this one thing, right? Here's some tips that I generally recommend if you're thinking about finding opportunity to sell cover calls. I always recommend that you focus on stocks that you're familiar with and stocks that you're comfortable investing in. You should never, look at this report and look for those really high yielding stocks and just only buy those stocks and buy them just purely for that, because the cover call premium is not enough to offset some of the risks that you might take. So you should only sell cover calls on stocks that you are comfortable and familiar with investing in. And then for those of you that do want to seek higher yielding income portfolios, what you simply want to do is sort by the raw return, which is the column that it defaults to. It defaults to sorting by the raw return. And what you simply want to do is go down the list and find the first stock that you own in your portfolio. So let's say you own CCJ because you've been buying some uranium stocks and you think they're going to do really well. So you have some CCJ, and this is telling you when the stock's currently trading at $22, if you sold the $29 call option, you'll collect about 40 cents or so. And what this is going to yield is about a 15% yield. And the stock has to rally about 30% in the next 43 days before the stock gets called away. Otherwise, you collect about 15% annualized yield on your portfolio. And you can just keep going down the list. And you can say, okay, now I also own some Snapchat. And then you can do the same thing again. And you just keep going down this list. And you can keep finding opportunities on stocks that you own. And the ones that are near the top of the list are the ones that yield the most income. And the ones at the bottom of the list are the ones that yield the lowest amount of income. Okay, so the other thing that some of you do want to be aware of is there's an earnings flag. We have an earnings flag on our report. And the earnings flag basically tells you, is there earnings between now and expiration? If there's a yes, that means there is earnings between now and expiration. If the answer is no, then there are no earnings between now and expiration. So obviously ETFs do not have earnings. And then if you have, for example, Stitch Fix, which doesn't report earnings until December 6th, when you sell, Stitch Fix, where did it go? SFIX. So as you can see, Stitch Fix doesn't have earnings until December 6th, so that's why it has an earnings flag of no. And you can use this to hopefully help sort for opportunities. Some of you like to sell cover calls going into earnings, some of you don't. So you can easily sort and filter those out. And lastly, like I said, I tend to find a lot of investors tell me that cover calls are only for big accounts. They're really not. There are plenty of lower price stocks that you can focus on selling cover calls on. So you can actually sort this list based on stock price. So for example, Ford is probably a good one right now. Stocks at 14, a little over shy of 15. If you sold the $17 call options, you're going to collect about 18 cents. That's going to come out to be a 10% yield. And the stock has to rally 15% in the next month and a half in order for this to get called away. And you can buy stocks here in the lower price range. So Ford, this is only $1,400 for every 100 shares. JetBlue, $1,500 for 100 shares Kinder Morgan energy stock, $1,600, $1,700. And you can kind of keep going down this list. American Airlines, $2,000. And you can find stocks that you want to buy that are in the $1,500, $2,000, $2,500 range for every 100 shares. So if you even have a smaller account, you can still trade this underlying strategy. AT&T falls under them. There's a lot of them in this particular category here right now. There's been plenty of stocks under $30 that you can choose that have a high amount of yield for these types of trades. So you can search for this based on yield and quickly gauge how much income that you're actually collecting for these opportunities. So that's just some of the tips that I have. So let's talk a little bit about what to do once you've sold a cover call and the stock either rallies, the stock moves sideways, or the stock declines. Okay, so let's first talk about when the stock rallies. So you sold the cover call and the stock rallies significantly. I see a lot of traders will ask me questions. They tend to panic, right? You sell a cover call, the stock rallies, and you see this large unrealized loss on the short call that you've sold, right? And this is where I see a lot of traders panic. And they ask me, what do? I have this huge loss on the short call that I've sold. And I always tell people, don't panic. You should never panic when the trade is going in the direction that you want it to. And remember, when you sell a cover call, you want the stock to rally because you own the stock, and when the stock rallies, you make money. So don't be concerned when the stock rallies after you sold the cover call. The rule of thumb here is that when the stock rallies, you don't do anything. You simply hold the position. If you need to roll the position because you think the stock is going to keep running and you think there's further upside, and this is usually because there's new information that has come out, right? So before, when you sold the cover call, you had a target price of 100, maybe some earnings came out, maybe some news came out. Now you think the stock's going to go to 120 with some new news that you have. Then this is really the only time where you might want to consider rolling your cover call. That means selling your existing cover call and buying back your existing cover call and selling a new one, buying back the old one, selling a new one. And a roll is just a fancy term for doing both trades in a single order. It's not something special. There's nothing new to it. You can do it as two separate trades, but if you do it as a single trade, we call it a roll. There's no special opportunities and rolls that you don't get elsewhere. But the most important part to remember is that if the stock rallies sharply after you sell a cover call, do not panic. You want to hold that position because many times the stock will rally significantly, and maybe after a couple of days, it comes back below your strike price. So many times, big moves will be preceded with a bit of a give back. So don't panic when the stock rallies significantly, because a lot of times, sometimes I see investors after the stock rallies, they start buying back their calls. And the second they do that, what you've done is you've locked in a loss on the cover call. And you don't want to lock in that loss. You always want to have the market give you the opportunity of giving back and for your cover calls to still expire worthless and keeping that income. If you roll your cover calls here, guess what? You've locked in the loss of that initial cover call, and if the stock declines, let's say the stock was to plummet, you only have a limited amount of reward to show for it versus the risk that you took on the short call to the upside is in theory unlimited, even though it's offset by the stock that you own. But on the way down, if you rolled your cover call, you're limited to how much premium you've collected on that second cover call. So don't roll your cover calls early. And this is really where I cannot stress enough for investors who are pissed off, if you will, when they sell a cover call and the stock rallies substantially. You have to adjust your mindset on this because you should be happy when the stock rallies significantly. Because when you're unhappy because the stock rallies significantly is the same reason you're basically unhappy that you weren't able to sell the stock at that exact price. Guess what? You're never going to be able to. So stop beating yourself up and being pissed that you didn't buy here, that you didn't buy here and you didn't sell there, because that's just never going to happen. Be happy that you bought here and then sold it, here. Because that's what a cover call is going to allow you to do. You're never going to be able to eke out every single penny. So if you sell a cover call, let's say the stock is trading sideways here, you sell a cover call up here and the stock rallies significantly and now you're able to take profit on it, you should be happy with that, because basically the stock that you thought was going to go up, did go up. It reached the target price that you were happy with, and you're now able to walk away with the profit. And you're able to take those profits and roll them into the next stock that you can buy that hopefully will also rally significantly as well. So you really have to change your mindset that when the stock gets called away, that's really a good thing. Now, I will say, it's only a good thing if you follow the methods that we're showing you, because we're selecting strike prices that are pretty far away, and the stock needs to rally significantly in order to get there. If you have an $88 stock and you sell a $90 call option and the stock rallies to $100, I can see why you're pissed, because you gave up $10 of income in exchange for an extra couple of bucks of income. You gave up $10 in upside in exchange for an extra couple of bucks in income, and you're pissed off about that. Well, there's only one solution for that: selling cover calls that are far away. Those 15 delta call options, that's how you protect yourself from these types of concerns. Does that make sense? Please type 6 into the chat window if that makes sense to you. Perfect. So what happens if the stock trades sideways? This is kind of your best case scenario. You simply hold your position. You can roll it if you want to once you've made 75% of the max reward on that cover call, but there's no harm in holding these trades to expiration. So if the stock doesn't really move, it's trading a little higher, a little lower, you can either hold them to expiration. For those of you that want to be a little bit more proactive, if you buy back a call, once you've made about 75% of the premium, you can sell another call and generate a little bit faster yield, if you will. But that really depends on how much time you have and whether you're managing these trades every single day. But the most important thing is that when you sell these cover calls that are moving sideways, a lot of times after the calls expire, we forget to the following Monday to start selling cover calls again, because you want to keep collecting income. And for the income stream to work, you have to keep selling cover calls. So remember, once the following Monday, once the expiration Friday comes, remember the following Monday, you have to get back on selling cover calls. So you go back to this report. I look at this report, most Mondays, because that's when my Friday cover calls have expired. And now on Monday, I got to sell a new cover call. Use these reports for your build into a habit. We send you these reports on Mondays as well in an email for those of you that are members. And for those of you that are on a free trial, you get an email as a reminder on Mondays, because that's when you want to initiate these cover calls. And lastly, if the stock declines, this is really the only scenario where it makes sense to do something early, because you sold something for maybe $1. Now you can buy it back for at least for maybe about 20% of the original premium. So if you sold something for $1 and it's now trading at 20 cents, so if you sold something for $100 and it's now trading at 20 cents, or rather $1, and now it's trading at 20 cents, then buy back the cover call and sell a new cover call. You're going to have to reduce, lower the price or strike price that you sell it at, but you're going to be able to collect more premium. Do not let these go to expiration, because what you're basically doing if you let these go to expiration is you're not going to be able to generate additional premium. And especially when the stock starts to decline, you want to generate more downside protection. You have an opportunity to do so. Take that opportunity when you're able to buy back the cover call that you've sold for 20% or less than what you originally sold it for. But the primary thing that you do want to start asking yourself at this point after the stock has declined is not necessarily, do I want to keep selling cover calls? But the more important question is, do I want to remain invested in the stock? Now, maybe something has changed. Maybe there's been a material change in the fundamentals. Maybe new earnings have come out. Maybe the CEO has resigned. Maybe the stock is just, underperforming the broader markets, and you're reconsidering whether this is a stock that you want to own. That's a question only you can answer. But if you choose, you should always make your decision based on that first. Do I still want to hold the stock? Because that's where your biggest risk is. If you don't want to hold the stock, get rid of the cover call and sell the stock. It doesn't matter where the cover call is. Sell the stock, get rid of the cover call. Your primary decision once the stock starts to decline should always be focused on the stock, not on the cover call. Does that make sense? Please type 7 into the chat window if that makes sense to you. Perfect. Okay, so we've covered what a cover call is. We've gone through an example. I've shown you the reports as to how to find these opportunities for your portfolio, how to analyze it using OptionsPlay, and how to manage these trades once you're in that cover call. Hopefully this gives you a strong understanding of the strategy, how to implement it, and then once you've implemented it, how to manage these in all three scenarios. So with that, what I want to just thank is our members for supporting us and allowing us to continue to do this. If you're watching this, especially if you're watching a recording and you want to have access to the tools I've shown you here today, the OptionsPlay platform, the cover call reports, you can sign up for a free 30-day trial at optionsplay.com. You're going to get access to the daily trading signals. You're going to get access to the platform as well as the cover call reports, and you're going to be able to learn with us on our Thursday options education sessions and our market outlook sessions that we host every single week to give you an understanding as to our views in the broader markets. And that is all available to you at optionsplay.com, which you can post into that, which I will post a chat into the chat window. With that, what I will do is open this up for Q&A. There is a Q&A section and a chat window here. Please type your questions into the Q&A section, and I'll try to answer as many questions as I have time for today. Are all the stocks in the cover call function rated bullish? No. So this covers all stocks, right? Because you don't just own bullish stocks in your portfolio. You might own some bearish stocks. You might own some stocks that you think are going to turn around, like Peloton. So no, this is not just bullish stocks. This is all liquid stocks, and all S&P 500 stocks and all liquid ETFs are covered in our cover call report. I assume we can use the cover call report for buy rights. Yes, you can, absolutely. Tony is the best teacher for options education and a great platform individual trader. Chantel, thank you so much. Yes, we are actually in the process of launching a mobile app as well, and you're going to be able to access the cover call reports. You're going to be able to access basic analytics on the new iPhone app here as well, iPhone and Android, I should say. But wouldn't you rather wait for the stock to rally, then sell a cover call for premium? So Super G asking, great question. His question was, why shouldn't you wait for the stock to rally, then sell a cover call? So let's say, for example, what he's saying is, why don't you wait for the stock to rally, then sell a cover call? And then hopefully when the stock drops, you're going to be able to collect that cover call premium. And Super G, you're right. From a tactical perspective, that certainly would be the best time to sell a cover call. But notice how there's not many opportunities for that. You maybe have one opportunity here and one opportunity there. So the goal here for cover calls is to generate cover calls or generate income every single month. And what you're trying to do is take advantage of that premium every single month. If you only wait for the market to top and then sell cover calls, then you're only generating income a very small percentage of the time throughout the year. So you're really not getting the benefit of the income stream. So you can do that, but you're going to miss out on most of the income. I'd like to know how about your TOR money management. How much would you risk on a single position? So if we're talking about, your stock positions, we tend to find that you can risk about at least 5% of your stock's portfolio in a single stock. And that's simply because the chances of a stock going to zero are relatively low compared to buying a call option, and the chances of that going to zero are substantially different. Ron is saying, looking at Peloton and OptionsPlay, it suggests the October 29th one. Let's look at Peloton. So Ron, I think what you're referring to are the cover calls based on your income setting. So you might have it set to short-term optimal or short-term aggressive, and that will show you the cover calls based on your income settings. So that's based on your income settings, and maybe you have it as set as short-term optimal. Yep, short-term optimal. That's why you have the October 29th $100 call options. You can do that, right? So this is based on your own settings. Our cover call report is based on our back-tested optimal settings for cover calls. So I do encourage investors to try to use the cover call report, because it's going to give you live prices of what we consider as the optimal cover call. Are there any rules on selling cover calls around dividend payments? Yes. Generally speaking, if the stock is paying a large dollar amount in terms of a dividend, you may be at risk of early assignment on that cover call. But keep in mind that it's kind of net the same, right? Because you're getting paid that dividend as the stock investor. Rather, I take that back. If you are at risk of early assignment, so I'll walk you through this. Basically, this is usually a concern in the last 1 to 2 weeks. In the last 1 to 2 weeks, if the dividend amount is greater than the extrinsic value, meaning the value that can decay at expiration. If the dividend amount is greater than the extrinsic value of the option in the last 1 to 2 weeks, especially if it's in the money, and this is only applicable if it's in the money. If the cover call that you've sold is out of the money, there's no dividend assignment risk. Only if a cover call is in the money and the dividend amount is greater than the extrinsic value that's left in the option, that's when you have risk of early assignment. Otherwise, there's no risk to you. So Super G, yeah, if you're underwater on a stock, yes, I understand that you are concerned about selling cover calls, but this is really where cover calls is a strategy that you have to start from the very beginning. You cannot sell cover calls, after the stock is down 40%. It's too late to start selling cover calls after you bought the stock and it's down 40%. Now you're trying to generate income or trying to build some downside protection. I'm sorry, you have to start this as soon as you own the stock. To pick my strike price is the strategy to buy the stock, then determine my exit price, and finally pick my cover call, the higher price than my exit price. No, what you want to do is you want to buy the stocks that you want to own and then use the cover call price to help you determine what is potentially a suitable target price. And again, these target prices are based on the stock rallying significantly. Looking at a firm, the stock's at 133. This is selling a 195. The stock has to rally 45% over the next 43 days before it gets called away. You can sell a cover call at your specific target price if you want. That certainly is a different strategy than this, but this is really using a probability-based approach. But you can also sell it at your specific target price if you have a specific target price that you want to choose. Can you sell cover calls weekly, bringing in less but more frequent than just selling 45 days? You can, Daniel, but what you're going to do is you're going to have your stock called away far more often. The reason that we sell 45 days is because you want capital appreciation of your stock. If you sell weekly options, you're going to sell calls that are probably 2-3% out of the money, and normal fluctuations will get your stock called away and you're not getting that capital appreciation. You typically own a stock because you want the stock to rally significantly. And if you sell weekly options against it, maybe 2 weeks in, the stock gets called away. And maybe it's an outsized move for 2 weeks, but an outsized move in 2 weeks might just be 2-3% move. And now you're out of the stock that you think is going to rally, 5, 10, 15% after just a 3% rally in a single week. So that's why you do not sell weekly options on cover calls. You've mentioned that you never see an option get assigned with more than 21 days left. That did just recently happen to me with Iron Condor. Got assigned to 22 days left. However, it was an in-the-money put that I sold because I didn't want to buy and the stock drops. So, James, it is always possible, right? And I bet that the stock dropped substantially. I haven't looked at Iron Mountain recently. It must have dropped fairly substantially below the strike price. And also, this pays a fairly substantial dividend, a 5.6% dividend. So that's probably why you saw that assignment. But it is very rare outside of 21 days. How do I find the low delta on stocks not on the list? So Howard, great question. Howard's saying, how do I find it for stocks that are not on the list? So let's go back to OptionsPlay. Let's say I'm just making up a name here, right? But let's say, for example, Harley-Davidson is not on the list. So what you can do is you can go to modify and you can select the expiration date that you want. Let's say you want to go to November 19th. And when you select the strike price has this column here on the right-hand side that has the delta. So The 41 is a 24 delta. The 42 is a 20 delta. The 43 is a 16 delta. So in this particular case, I would choose somewhere between 42 and 43, somewhere between these two strike prices, maybe the 43. As you can see, that will be the 16 delta. So this will generate 9.4% annualized yield on a stock that generates 1.3% yield at the moment. So this is allowing me to collect about 4 times the dividend yield on Harley Davidson by selling the November 43 calls. And the stock has to rally pretty significantly from the $36 that it's trading at right now, all the way up to $43, which is the prior resistance. So basically it gets yourself back to this prior resistance level. The stock has to rally that much in order for the stock to get called away. Otherwise, you're collecting 9% yield. And 9% yield is probably going to look pretty good on a stock that continues to trend lower as you're trying to buy some more downside protection. When the stock moves sideways, can you let it literally expire? Yes. If the stock moves sideways, you can let it literally expire and come back the next Monday. You don't know if it's nowhere near your strike price, you do not need to close it before expiration. Can you check Intel? Sure. Let's take a look at Intel. Intel is currently trading at $54.24. This is telling me to sell the $60 strike price. So a strike price that's about 10% out of the money. I'm going to collect 0.86% over the next 43 days, which is annualizes out to 7.26%. So looking at the November, $60 call options on Intel. So I think I've referred to, the why I don't believe in selling short dated cover calls. It's because you can have a quote unquote outsized move in a weekly move, but that 2% move, which is outsized for that 1 week, takes you out of the stock entirely. Don't do it. What about selling cover calls in a week? Oh, I've already answered that. Are index ETFs listed on this report? If there are income opportunities, yes. Not all of them are here. Some of the, on SPY, you're just not generating enough income for these types of trades. IWM is on here. EEM, I believe, is on here. RSP is on here. So quite a few of them are on here. IYT. So a lot of them are on this. So ETFs are listed. 75% gain at what point during the trade? I'm not sure what you mean by William. If you sell something for $1 and it's now trading at 25 cents, then you've made 75% of the max reward. That's the trigger point of which you might want to just roll your cover call, buy back the cover call, pay 25 cents, and hopefully sell another option 45 days out for another $1. I usually get into the stock by selling a put option for where I'd like to get in. Any problem with this? None whatsoever, Sean. This is what you do after you sell that short put. And I'm actually going to cover short puts next. This is just one half of the equation. I really wanted to spend some time on just one half the equation and showing everyone how to really master cover calls. Once you've mastered cover calls, then we're going to look at short puts. So you've got one half today. We're going to cover the other half next time, and we're going to combine them into what we call the wheel strategy, where you're selling cash secured puts, collecting income to buy puts at buy stocks at a discount. Once you've bought those stocks at a discount, you put in a cover call to generate a yield on the stocks that you own in your portfolio and collect a yield. And once the stock rallies significantly, you then take the profits and you put them back into selling puts again. Regarding a poor man's cover call, would you say that's too risky of a strategy? No, I would not say a poor man's cover call is too risky of a strategy. I'm not sure what you mean by why that would be any riskier than this particular strategy. Wayne, thank you so much. What do you think about investors that run the wheel strategy? Hopefully I just talked about that. We're going to cover puts next. So today we spent all our time talking about, one half of the wheel strategy. Next time we're going to talk about the other half, selling puts. Poor man's cover call, you choose the exact same deltas and the exact same strikes for poor man's cover call. Is it better to wait for an up day to sell instead of a down day? James, you can if you want to be a little bit more tactical. There certainly is probably some statistical edge to doing so. I will say that if you wait, many times you end up losing out on income, and you end up losing out on, well, you really just lose out on income. What are others also don't realize is that not only are you making monthly income, you're lowering your cost basis on the holding. Yeah, Greg is saying he loves cover calls for those reasons. So thank you so much, Greg, for sharing that. Should I run cover call on stocks on which I'm losing money? So you can, but I will say that if you're already down 30, 40, 50% on a stock that you own, selling cover calls on it may be a little too late. That's why this is a strategy that you want to apply to new holdings that you acquire in the future, rather than stocks that you're down a lot of money on. But stocks that you're up a lot of money on, I certainly recommend selling cover calls on those. When does it make sense to buy back a cover call instead of letting the stock being called away in a big price jump? So hopefully I answered that question for you in our session where I discussed exactly that. You do not want to buy that early, buy back that cover call early when the stock jumps substantially. I don't remember Tom Sosnoff suggesting a delta of 35. If he did, you're going to have to ask him why he chooses 35. I think our back test, as well as quite a few other industry back testing companies, if you look at ORATS, which is a company that specializes in options back testing, they've done a huge cover call back testing, and their conclusions are almost identical to us. They choose, I think, either 10 or the 15 delta cover calls. They use the 30 and 45 days as their optimal settings. We're talking about institutional customers, wealth pension funds that use this type of strategy, that have back tested this, and consistently the results clearly show that those really high really low deltas, very high strike prices, are the ones that generate the most, the best beneficial outcome in the long run. And that outcome includes the stocks that you own in your portfolio, because you don't want your stocks to get called away too early. Otherwise, you're missing out on upside in the stocks that you own. Can't the delta move substantially on some stocks in 45 days? Wayne, I'm not sure I understand your question. I don't know what you mean by that. You're only concerned about the delta at the time you establish the trade. Once you establish the trade, the deltas can move. No matter, that doesn't matter to you. You only want to select your strike prices based on the time that you enter the trade. Few people have asked me to check some stocks. So just to come to the report, ATH, I don't have one on here. Pins, I do have one, the November 65 calls. So on the OptionsPlay platform, click on the education and resources section here on the upper right-hand corner. That's going to bring you to the OptionsPlay hub. And then within the hub, you'll see the cover call report. When you access it, you'll be able to type in your own symbol here on the upper right-hand corner. Just type the symbols on the stocks that you own. That'll quickly help you find these opportunities. So with that, that covers the questions that I have time for here today. I hope that this was helpful in giving you a better understanding as to how to use these types of strategies, and hopefully help you master selling cover calls on your portfolio. With that, thank you so much. I hope you guys have a great trading day. And just a quick reminder again, for those of you that are on, that want to sign up for a free trial to everything we discussed here today, you can do so at optionsplay.com. Thank you so much and have a great trading day.